Good morning, and welcome to the VAALCO Energy fourth quarter and full year 2022 earnings conference call. All participants will be in a listen-only mode. Should you need any assistance today, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star, then 1 on your telephone keypad. If you would like to withdraw your question, please press star, then 2. Please also note that this event is being recorded today. I would now like to turn the conference over to Al Petrie, Investor Relations Coordinator. Please go ahead, sir.
Thank you, operator. Welcome to VAALCO Energy's fourth quarter and full year 2022 conference call. After I cover the forward-looking statements, George Maxwell, our CEO, will review key highlights of the fourth quarter and full year 2022. Ron Bain, our CFO, will then provide a more in-depth financial review. George will then return for some closing comments before we take your questions. During our question and answer session, we ask you to limit your questions to 1 and a follow-up. You can always re-enter the queue with additional questions. I'd like to point out that we posted a supplemental investor deck on our website that has additional financial analysis, comparisons, and guidance that should be helpful. With that, let me proceed with our forward-looking statement comments. During the course of this conference call, the company will be making forward-looking statements. Investors are cautioned that forward-looking statements are not guarantees of future performance, and those actual results or developments may differ materially from those projected in the forward-looking statements. VAALCO disclaims any intention or obligation to update or revise any forward-looking statements, whether as a result of new information, future events, or otherwise. Accordingly, you should not place undue reliance on forward-looking statements. These and other risks are described in our earnings release, the presentation posted on our website, and in the reports we file with the SEC, including our Form 10-K. Please note that this conference call is being recorded. Let me turn the call over to George.
Thank you, Al. Welcome to our fourth quarter and full year 2022 earnings conference call. 2022 was truly a transformational year for VAALCO that saw us generate record financial results, successfully complete multiple high-impact operational projects, close an acquisition that nearly doubled production, diversify our asset base, and increase SEC proved reserves by 150%. Additionally, we implemented our first ever dividend program in 2022, paying out $9.3 million in dividends to shareholders. In 2023, we increased our dividend by 92% and approved a stock buyback program in late 2022 to further demonstrate and enhance our commitment to returning meaningful value to our shareholders. Our balance sheet remains debt-free even after we fully funded the largest capital program in our company history that included drilling multiple wells and completely reconfiguring our Etame field infrastructure while adding a long-lasting FSO solution that lowered costs and extended the economic field life at Etame. We have a strong production base to help us generate significant cash flow moving forward to fund our dividend, buybacks, capital programs, and potentially additional acquisitions where we build additional cash for the future. Before I go into more detail on these many accomplishments, let me first summarize some high-level financial and operational results that led to a record-breaking year. We grew production by over 40% year over year, which helped us deliver record-breaking adjusted EBITDAX of $186.6 million in 2022. To put this in perspective, we generated $85.8 million in all of 2021 and $26.6 million in 2020. We fully funded a $160 million capital program with cash on hand and cash from operations. We maintained a strong, debt-free balance sheet with significant cash on hand and positioned ourselves to generate meaningful free cash flow in 2023. We have positive momentum in 2023 both operationally and financially, and we are building size and scale to substantially grow VAALCO. On the TransGlobe acquisition, On October 13, we completed the transformational combination with TransGlobe, which has built a business of scale with a stronger balance sheet and a more diversified production base that de-risks our overall portfolio and will underpin VAALCO's future opportunities for success. VAALCO now has a diversified portfolio of assets across 4 countries, including Gabon, Egypt, Equatorial Guinea, and Canada. This larger diversified production base positions us to generate meaningful cash flow in 2023 and beyond to fund the increased stockholder dividends, share buybacks, and potential supplemental stockholder returns at a rate that would not have been achievable by either VAALCO or TransGlobe on a standalone basis. We are also capturing meaningful synergies as a result of the combination, and the first tranches that we initially outlined have already been captured. We cancelled the additional public listings, streamlined the total number of board and executive positions, actioned a more efficient corporate structure, consolidated our advisors, and reduced external reporting requirements. This will save us up to $5 million per year annually, but this is only the beginning. We are increasing automation, digitalization, and back-office efficiencies, as well as initiating service, supply chain, and operational savings that could potentially double the amount of annualized savings as we continue to implement them over the next 18 to 24 months. A key part of the value proposition around the combination was the opportunity to significantly increase shareholder returns. In 2022, through dividends and share buybacks, we returned over $12 million in cash to our shareholders. In February of 2023, we nearly doubled our quarterly dividend to 0.625 cents per share, or 25 cents per share annually, from the 13 cents per share in 2022. Based on where our stock is currently trading, this would give a dividend yield of over 5%, which is compelling in today's market. This dividend, when coupled with a share buyback, provides a meaningful return of cash to our shareholders in 2023. When this is combined with the capital appreciation we aim to deliver through our operational efficiency, the result is a strong investment proposition. We believe the market has not yet recognized the value that was created from the combination of our 2 companies into a single entity, making right now a particularly opportune time for a buyback program. Bottom line is, this acquisition propels VAALCO to a much stronger position both operationally and financially, providing diversification to maximize cash flow in different pricing environments, reducing the overall risk to our shareholders, and allowing us to return additional value to our shareholders. This is done through cash distributions, but also by prudently investing in the future, in our very promising asset base across our 4 countries to continue to grow cash flow. We also continue to evaluate additional accretive acquisition opportunities to invest in that will further build value. The TransGlobe acquisition was a major accomplishment for VAALCO in 2022, but it was only one of many. At Gabon, we completed a drilling campaign, reconfigured the Etame field for efficiency, and entered into a long-term contract for an upgraded FSO. Now to review Gabon. With the FSO, we successfully completed the highly complex FSO installation, field reconfiguration, and full field turnaround in October of 2022. As we have noted, this project positions us to realise substantial and sustainable operating cost savings in 2023 and continuing through the remainder of the decade. The new FSO provides us with additional flexibility and has an effective capacity for storage that is approximately 50% larger than the previous FPSO. The lower overall cost will also lead to an extension of the economic field life, resulting in a corresponding increase in recovery and reserves at Etame. This project was an incredible feat from an engineering, logistical and operational standpoint. I would like to put this in perspective for you. We had about 5 times the number of personnel in the field during the project, with additional boats, equipment and operational responsibilities, all working to ensure that we coordinate and complete this substantial project with minimal downtime to our production. We also had specialised equipment being manufactured, delivered and installed from all over the world, during a particularly difficult worldwide supply chain environment. Availability of equipment, consumables and global logistics have been strained over the past 2 years, which led to upward cost pressure and some delays. Remaining committed to safety and operational excellence, we took every opportunity to reduce project risk exposure. This effort increased our project costs but eliminated costly delays, ensured employee safety, mitigated the overall project risk and ensured minimum production interruptions during installation. A project of this magnitude with regards to Etame occurs once every 20 years, and I am extremely proud of how our team managed and minimised the risk associated with such a large and complex project. Heart Energy wrote an interesting story about this project which we have posted on the homepage of our website, and I think you would enjoy reading. Ron will review the costs of the project and our financials in more detail, but we are seeing the cost savings materialise in our Etame operations in 2023 and moving forward with about $13 to $16 million of annual savings net to VAALCO in operational costs through 2030. Turning to the 2021-2022 drilling campaign. Our attention to the drilling campaign at Etame. We have had tremendous success at Etame drilling and developing the vast resource over the past 20 years. Our overall 2021-2022 drilling campaign was a success as the 2 initial wells were highly successful and exceeded our pre-drill estimates. The program has materially increased production and extended the economic life of the Etame field, thereby fulfilling the primary objectives of the campaign. We forecast the total drilling program at Etame will achieve payback in 2023 and have strong overall economics at the current strip pricing, demonstrating the strong cash flow profile generated from this quality asset. Our 2 highly successful wells, the Etame 8HST and the Avuma 3HST wells, were brought online with rates above our initial internal estimates. The 3rd and 4th wells, the South Chihuahua 1 HBST and the North Chihuahua 2HST wells, both encountered dentally producing zones, but the production rates and reservoir permeabilities for these wells were below our expectations. In addition to drilling the 4 wells, and with the rig already on site, it made performing 2 workovers easier and more economic. The first workover was needed due to a safety valve in the well that required replacement. The second workover on the ETSEM-4H restored production of about 1,350 gross barrels of oil per day. This well went offline as a result of an upper ESP failure and was restored in late Q4. We are evaluating the learnings from this most recent drilling campaign and further evaluating prospects for our next drilling campaign at Etame. We have reviewed our internal processes for target evaluation and proposal planning and have augmented these into a more integrated approach. This process is being applied to the next drilling campaign, which will likely begin mid to late 2024, subject to rig availability. With this, we will incorporate all of our learnings from our last 2 drilling campaigns in Gabon into our planning process, and we are making the necessary changes to do that effectively. Our implementation of the next drilling campaign will depend on rig availability, commodity pricing, supply chain issues, and procurement of long lead items, so the exact timing is yet to be determined. We are focused on drilling additional Gamba targets in the next drilling program, while we continue to better map and understand deeper dental potential across Etame. Our primary objectives with any future drilling are successfully adding production and extending the economic life of our Etame asset. We will share with the market additional details on our next drilling campaign once we have our planning complete. Let me reiterate that we accomplished that with our 2021-2022 drilling campaign, and the overall economics of the entire drilling campaign are expected to be over 100% internal rate of return given realised pricing and current strip pricing. This is a very attractive rate of return, especially for a company with no debt, strong cash flow and a low cost of capital. On Equatorial Guinea, now let me turn to a discussion on Equatorial Guinea, another area that holds significant future potential for VAALCO. VAALCO owns a working interest in Block P offshore Equatorial Guinea, where there have previously discovered but undeveloped resources as well as an additional exploration potential. In March 2023, we held productive meetings with the Ministry of Mines and Hydrocarbons and our partners in Houston. During these meetings, we finalised multiple substantive documents for Block P, which includes the various development relating to the production sharing contract. We are working on concluding remaining documents and expect to update the market in the second quarter of 2023. We are excited about the future of Equatorial Guinea, and we anticipate a strong, efficient and economic development of this discovery, with first oil projected for 2026. Additionally, there are clear strategic benefits in further diversifying the revenue generation and country focus of our portfolio. We have a proven track record for a development of this kind, and we look forward to demonstrating these capabilities as we progress the Venus discovery into production. In Egypt, we are focused on drilling opportunities in Egypt, which include drilling the first ever Nukhul horizontal well on our acreage. This well was spudded in December of 2022, and the lateral was successfully drilled, encountering good oil and gas shows. Our drilling and completions program in Egypt will be a large part of our 2023 capital program, and we continue to develop one of our anchor assets. In Canada, in the fourth quarter, we drilled several wells in Canada, but completions were delayed into 2023. We will drill a couple more wells as part of our Canadian program and complete them all in 2023. Turning to reserves, we are very pleased with the substantial growth of our reserve base, which was driven by several of the accomplishments that I have already discussed this morning. We have added 18.6 million barrels of oil equivalent from the TransGlobe acquisition and 2 million barrels of oil equivalent from positive revisions, which significantly boosted our SEC proved reserves. The proved reserve increase was partially offset by production of 3.9 million barrels of oil equivalent. SEC proved reserves at year-end increased by 149% to 27.9 million barrels of oil equivalent. This compelling increase in our SEC proved reserves does not include any positive impact from Equatorial Guinea. We believe that once the final documents are executed for Equatorial Guinea, we will begin adding proved reserves as we proceed with the development plan. The PV10 value of our proved reserves utilizing SEC pricing of approximately $100 per barrel dated Brent increased by 529%, from $99.3 million to $624 million. This was largely driven by the TransGlobe transaction and from the SEC pricing increase. Our 2P CPR estimate, which includes proven and probable reserves using VAALCO's management assumptions for future Brent escalated crude oil pricing and costs, reported on a working interest basis prior to deductions for government royalties, saw a year-over-year increase of 292% to 76.4 million barrels of oil equivalent. The 2P CPR NPV10 value increased more than 4 times, from 183.7 million at year-end 2021 to 815 million at year-end 2022. I would like to point out that pricing played only a small role in these 2P CPR increases, as pricing was kept broadly similar year on year. The overall NPV10 for our SEC proved reserves and our management 2P CPR is significantly higher than our current market cap of around $500 million. We have no debt and a net positive cash and working capital position, but remain significantly undervalued. I will now review reserves and valuation by asset area. At Gabon, we saw positive technical revisions at Etame and from southeast Etame and Ebouri fields, as well as strong performance from the Etame field, primarily driven by the newly drilled ET8H well. However, these positive technical movements were outweighed by disappointing drill result from North Chebuela Gamba well and South Chebuela Dental well and Avuma field revisions. Taking into account the upward pricing revisions and production for 2022, our net SEC proved reserves at Etame were down 9% year over year to 10.2 million barrels of oil. We replaced 67% of 2022 production with new SEC proved reserves at Etame. Our proved SEC NPV10 for Etame did increase by 246% to 244 million at year-end 2022. As I stated earlier, we continue to work on high grading and better identifying future drilling locations at Etame, which we believe will help to increase our reserves in the future. We remain confident in the value of our future potential at Etame. We are planning to return to drilling in Etame in 2024 pending rig availability and commodity pricing, with a drilling campaign heavily weighted on Gamba opportunities. I would now like to discuss the two asset bases that we acquired last year with the TransGlobe transaction and remind you that since we are adding those to VAALCO's reserve base, I will not be giving year-over-year comparisons for these areas. Turning now to Egypt. Our net 2022 SEC proved reserves were 8.6 million barrels of oil, and our proved SEC NPV10 for Egypt was 227 million at year-end 2022. For 2022 SEC proved reserves, we had a 20% reserve replacement, and despite positive impacts due to pricing overall, quite a bit of the upside was offset by reduced cost pools due to higher pricing. We see strong upside potential in Egypt and will be focusing our 2023 capital program on development opportunities in Egypt. Looking at Canada, our net 2022 SEC proved reserves were 9.2 million barrels of oil equivalent, and our proved SEC NPV10 for Canada was $153 million at year-end 2022. For 2022 SEC reserves, we had a 267% reserve replacement driven by the 2022 capital program that has strong reserves due to most of these wells not being captured in the previous SEC proved reserve base. In summary, there is a lot to be excited about as we enter 2023. I would like to thank our hard-working team who continue to operate and execute on our strategic vision. We have captured meaningful synergies of the TransGlobe acquisition already and continue to make progress towards capturing more, all while continuing to build size and scale. We have completed the highly complex FSO and full field reconfiguration at Etame while completing another drilling campaign. We are working on concluding remaining documents at Block P in Equatorial Guinea and anticipate a strong, efficient and economic development of the Venus discovery with first oil projected for 2026. We are debt-free and remain firmly focused on our strategic vision of accretive growth while maximising shareholder return opportunities and operating with the highest regard towards ESG. With that, I would like to turn the call over to Ron to share our financial results.
Thank you, George. Let me begin by echoing George's comments about our execution on several complex operational and corporate projects simultaneously, including the closing the acquisition of TransGlobe in the fourth quarter of 2022. I am pleased with our record annual operating performance in 2022, and as we look to 2023 and beyond, we are better positioned today to execute on our strategy while adding and returning value to our shareholders. Turning to our financials, we generated an adjusted EBITDAX of $49.8 million in the fourth quarter of 2022 and a record $186.6 million in 2022. This was more than double the $85.8 million in 2021. The record adjusted EBITDAX was primarily due to sales volumes increasing by 36% year over year, and average sales price for crude oil increasing by 34%. We've clearly benefited from higher realized oil pricing, the impact of increased production at Etame, and the TransGlobe acquisition, which only contributed to financials after the closing on acquisition on October the 13th, 2022. These factors have allowed us to fund our strategic initiatives with cash flow and cash on hand, including our drilling and completions capex, FSO conversion, and field reconfiguration costs, as well as our quarterly dividends and our share buyback. We also reported net income of $17.8 million, or 19 cents per diluted share, in the fourth quarter of 2022, which included a $10.8 million gain on acquisition, a $5.3 million deferred tax expense, and a $7 million in transaction costs associated with the TransGlobe combination. For the full year 2022, VAALCO reported net income of $51.9 million, or 74 cents per diluted share, which included a $44.8 million deferred tax expense, $14.6 million in transaction costs associated with the TransGlobe combination, a $10.8 million gain on acquisition, $8.9 million in FPSO demobilization costs, and a $5.1 million in unrealized derivative gains. After normalizing for the deferred tax charge, transaction costs, gain on acquisition, FPSO charges, and the unrealized derivative gain, our adjusted net income for the full year 2022 totaled $104.3 million, or $1.49 per diluted share, as compared to an adjusted net income of $39.6 million, or 67 cents per diluted share for 2021. The same factors that drove record adjusted EBITDAX helped to meaningfully increase adjusted net income as well. Production for the fourth quarter of 14,390 net barrels of oil equivalent per day was up by 57% compared to 9,157 net barrels of oil per day in the third quarter of 2022. Production for the full year 2022 was up 43% from the same period in 2021 due to a drilling program and the production benefit from the TransGlobe transaction after October 14, 2022. Sales volumes in Q4 2022 were 1.37 million BOE, which was 88% higher than the third quarter of 731,000, and a full year 2022 sales increased 35% to 3.68 million BOE. In the fourth quarter, we had sales across Gabon, Egypt, and Canada for the first time. Offsetting the benefit of these high sales volumes was a 32% decrease in realized commodity pricing in the quarter compared to Q3 2022. Despite the decline, we are pleased with our continued strong commodity price realization, which was $70.43 per barrel of oil equivalent in the fourth quarter of 2022. With Canada containing natural gas and natural gas liquids, Egyptian pricing driven by the Ras Gharib blend, or pricing will be blended versus the past when it was tied to only Brent oil. We continue to implement a hedging program to help us provide surety to fund our capital program, mitigate risk, and also to protect our commitment to shareholder returns. We have protected, via costless collars, a floor price of $65 for a percentage of our production through the first half of the year, with upside to at least $100. As we look at 2023 and beyond, we will continue to implement our strategy and examine our capital spending outlay in the near term and the longer term. Our full derivative position can be found in the year-end earnings release, as well as in our supplemental information presentation on our website. Turning to expenses. Production expense, excluding offshore workovers and stock-based compensation for the fourth quarter of 2022, was $40.8 million, and for the full year 2022 was $107.9 million. These were sequential increases compared to prior periods, driven by higher sales volumes, inflationary pressures, and higher levels of operational work in 2022. The inflationary pressure was seen in fuel, boats, personnel, chemicals, and miscellaneous costs. We are monitoring our costs and looking for ways to safely reduce expense, but believe that the elevated cost levels driven by the inflationary pressures may continue into 2023. There continues to be increased competition for services. Over the past 2 years, we saw a decrease in the number of overall service providers across the supply chain. From a macro level, both the higher demand and the lower supply of services is driving costs higher across the industry. We believe inflationary pressures could continue as we benefit from higher commodity pricing. We had no offshore workovers in the first 3 quarters of 2022, but in the fourth quarter of 2022, we performed 2 offshore workovers for $4.7 million. Both workovers were in Gabon, with one due to a safety valve in the well that required replacement. The second was to restore production on the Southeast Etame 4H well, which went offline as a result of an upper ESP failure, and VAALCO was unable to restart the upper ESP or the lower ESP to restore production. We were able to restore production in Q4 to that well, supporting the base production at Etame. In the third quarter 2022, we had a one-time charge related to the FPSO demobilization costs of $8.9 million. This allowed us to continue producing into the Natipa beyond the term of the original contract and allowed us to produce more barrels than we had previously guided for Q3. These one-time costs were incurred to retire the FPSO as we transitioned to the FSO. There were no similar expenses incurred in the fourth quarter of 2022. After year-end, these costs were cash funded from the abandonment fund. Depreciation, depletion and amortization expense for the 3 months ended December the 31st, 2022 increased to $26.3 million, which was higher than the third quarter of 2022 of $9 million and higher than the $4.1 million in the fourth quarter of 2021. The increase in depreciation, depletion and amortization expense compared to both periods is due to higher depletable costs associated with the FSO field reconfiguration, as well as step up to the fair value of DD&A associated with Egypt and Canada following the TransGlobe acquisition. General and administrative expense for the fourth quarter of 2022, excluding stock-based compensation expense, decreased to a negative $0.3 million compared with $2 million in the third quarter of 2022 and $2.2 million in the fourth quarter of 2021. The decrease compared to prior periods was primarily driven by a large increase in operational projects involving a majority of corporate resources, which realized a high percentage of cost charged to projects. For the full year 2022, G&A cost, excluding stock-based compensation, was $8 million, a decrease of 35% compared with the full year 2021. G&A non-cash stock-based compensation expense for the fourth quarter of 2022 was a negative $0.1 million, and for the full year 2022, it was $2.1 million. Income tax expense for the 3 months ended December the 31st, 2022 was $6.9 million. This is comprised of a $5.3 million of deferred tax expense and a current tax expense of $1.6 million. From a cash tax standpoint, the only tax paid is on our profit barrels in both Gabon and in Egypt. No cash tax is payable in Canada due to the availability of net operating losses. The Gabonese government takes their taxes in kind through an annual lifting. That lifting occurred in December 2022. We accrue quarterly during the year for the estimated value of the barrels they will lift using quarter-end oil pricing. We then adjust for the actual cost based on the pricing at the time the lifting occurs. The current tax liability was settled in December by the state taking their barrels. To recap, we build up the liability during the year, which impacts working capital akin to extending payables. Then when we settle, it's an outflow of working capital. This is why it impacts our overall cash from operations on the cash flow statement. For the year ended 31st of December 2022, income tax was an expense of $71.4 million, comprised of a current tax expense of $26.6 million and a deferred tax expense of $44.8 million. The effective tax rate for the year was 57.8% compared to our PSC tax rate in Gabon of 52.5%. We generated $186.6 million in adjusted EBITDAX in 2022, which is more than double what we generated in 2021. With our recent stock price around $4.50, we continue to trade at a very low multiple of EBITDAX. despite paying a strong dividend yield and being debt-free. Additionally, with the TransGlobe combination, we should see a step up in adjusted EBITDAX in 2023, depending on commodity prices. Our increased market cap implies that we should be trading at a much higher multiple that similar-sized companies enjoy. We believe that we are truly undervalued, and that is another reason that we are excited about our share buyback program. We believe right now is an excellent opportunity to buy our common shares at a discount to their intrinsic value and are a very attractive investment of our cash balance. At December the 31st, 2022, we had unrestricted cash balance of $37 million. A breakdown in the source and use of cash from the 30th of September is provided in the supplementary deck. TransGlobe had $17 million in completion-related costs to acquisition date, and VAALCO had $7 million of completion costs. This, together with the annual state lifting, which settled our tax liability for the year, were singular events that occurred only in the fourth quarter. Adjusted working capital at December the 31st, 2022 grew to $44.2 million, compared with a negative $19 million at September the 30th, 2022. Receivables grew with the inclusion of TransGlobe, with $52 million of outstanding accounts receivable. We had $46 million outstanding with EGPC at the 31st of December for September through December sales invoices. There were only direct sales in Egypt in Q4, and we successfully were provided a cargo in February 2023, lifted 450,000 barrels and were paid offshore. Monetization is generally via export cargoes. In addition, due to the drilling campaign commencing in Q4, we were provided a cash payment of $10 million in Q4. Historically, TGA has approximately $3 to $4 million per month of expenditure with EGPC sister companies and has successfully managed this via offsets. Again, historically, as part of the marriage concession, we had an annual commitment for 5 years to pay $10 million per annum as a modernisation payment, and this, in February 2023, was achieved not through a cash payment, but via an offset. Canadian accounts receivable was $4.5 million for December, and that's since collected in January. And Gabon, for accounts receivable, was $1.7 million, and again, since collected in January. Other balance sheet items worth highlighting are other assets, where we hold the backdated entitlement receivable with EGPC of approximately $51 million and continue to work with EGPC on collection. Right of use assets have changed with the completion of the contract for the Natipa FPSO coming out of operating lease assets and the replacement of the Tele FSO within the finance lease assets. In conjunction with the TransGlobe merger, VAALCO assumed an existing revolving loan facility with Alberta Treasury branches. At the time of closing the merger, there were outstanding funds, which we repaid, and on January 5, 2023, we decided to exit the facility completely. We will continue to work with our banking group to potentially incorporate and expand our current facility to include the TransGlobe assets. As has been the case since the third quarter of 2018, we are carrying no debt and have facilities available to utilise for additional accretive acquisition opportunities to continue to build our value. For the full year 2022, net capital expenditures, excluding acquisitions, totaled $159.9 million on a cash basis and $178.5 million on an accrual basis. These expenditures were primarily related to costs associated with the 2021-2022 drilling program, the FSO conversion, and the Etame field reconfiguration, as well as drilling activity in Egypt and Canada. In 2022, VAALCO paid quarterly cash dividends of 3.25 cents per common share beginning in Q1 2022 for a total of 13 cents per share annually. That equates to about $9.3 million in cash returned to shareholders through dividends in 2022. In addition, for 2023, the board approved nearly doubling the dividend to 6.25 cents per share quarterly or 25 cents per share annually. The Q1 2023 dividend was paid on March 31st, 2023 to stockholders of record at the close of business on March 24th, 2023. As stated previously, growing the dividend is a direct result of our increased asset base and cash flow generation ability as a result of the TransGlobe acquisition. Additionally, in November 2022, the Board approved a share buyback program that provides for an aggregate purchase of currently outstanding common stock of up to $30 million. Through March 31st, 2023, VAALCO has repurchased a total of $7.5 million worth of shares, or about 1.55 million shares. With the completion of the TransGlobe acquisition on October 13, 2022, we have incorporated all the assets and costs into our guidance moving forward, and both Q1 2023 and full year 2023 guidance are available on our supplemental deck. As a reminder, we show all of our production with working interest and net realised interest. The difference between production working interest and net revenue interest represents royalties paid or taken in barrels. For the total company, we are forecasting Q1 2023 production to be between 22,500 and 23,800 on a working interest barrels of oil equivalent per day, and between 17,300 and 18,600 NRI BOE per day. Looking at production by asset, we are expecting Gabon to be between 8,700 and 9,100 NRI BOE per day, Egypt to be between 6,400 and 7,100 NRI BOE per day, and Canada to be between 2,200 and 2,400 NRI BOE per day. For the full year 2023, we're forecasting our total company production to be between 20,400 and 24,400 WI BOE per day, and between 15,300 and 18,600 NRI BOE per day. Looking at production by asset, we're expecting Gabon to be between 7,400 and 9,000 NRI BOE per day, Egypt to be between 6,000 and 7,300 NRI BOE per day, and Canada to be between 1,900 and 2,300 NRI BOE per day. For the full year 2023, we're assuming our sales will be in line with our production, but for the first quarter, this was not the case. You will notice that Q1 sales were lower than production because a lifting in Gabon shifted from March into April. We have just completed this lifting of about 630,000 barrels of oil in early April. Turning to costs for the first quarter 2023, we expect production expense, excluding workover and stock compensation, to be between $28 and $34 million on an absolute basis, or between $17.50 and $21 on a working interest per barrel of oil equivalent basis. We also expect offshore workovers to be between $0 and $1 million. Our cash G&A for the combined company is expected to be between $3.5 and $5.5 million. For the full year 2023, we expect production expense, excluding offshore workover and stock compensation, to be between $135 and $157 million on an absolute basis, or between $16 and $20 per BOE. We also expect offshore workovers to be between $4 and $10 million. Our cash G&A for the combined company is expected to be between $15 and $20 million. Finally, looking at CapEx for the first quarter of 2023, we are forecasting between $25 and $35 million of CapEx spend. For the full year 2023, we are forecasting between $70 and $90 million. In 2023, our drilling and completion program is focused in Egypt and Canada. In addition, we have some long lead items for a future drilling campaign in Gabon and some maintenance capital. Approximately 50% of our 2023 capital is earmarked for Egypt, with the remaining 50% split between Canada, long lead items and maintenance capital. We have 10 to 15 wells planned in Egypt, and in Canada we are planned to drill between 4 and 8 wells. Also, our capital spending is weighted for the first half of 2023, which can be seen in our Q1 guidance amount compared to the full year 2023 forecast. This does not include any capital associated with Equatorial Guinea, but we are assessing the timeline and capital needs for the development plan at the Venus discovery in Block B, and we will have more information associated with EG as we move through 2023, with a target of first production from EG in 2026. You can see full year and first quarter 2023 guidance in the supplemental slide deck on our website. Additionally, we've added a netback slide to the presentation that shows netbacks for each of the areas broken out by liquids and natural gas. There is also a total company blended netback at different realised pricing, where we break out the major cash costs to approximately a free cash flow before capex and working capital changes. One of the costs shown is a differential. Traditionally, VAALCO is sold in Gabon based on dated Brent, with a differential that was sometimes a premium and sometimes a discount, but overall it was negligible. Now we have Canadian oil, natural gas and NGLs, all of which trade at a discount based on the market that they are sold in. Also, in Egypt, we're marked off of Ras Gharib blend, which is generally a discount to Brent, with a further discount for quality of the crude. We're hoping that this additional information and transparency will provide better clarity to the profitability of our producing areas and the company in total at different pricing scenarios. With that, I will now turn the call back over to George.
Thanks, Ron. As you heard, 2022 was a very successful and transformative year for VAALCO. We completed an all-equity combination of two undervalued companies, VAALCO and TransGlobe, that provides us additional size, scale, cash flow, geographical diversity, and created a more de-risked portfolio. We expect our enhanced size and scale to yield meaningful cost synergies, the first tranche of which we have already captured, and we should benefit from a higher trading multiple that has accorded E&Ps with that increased market capitalization. We now have a vast resource base of organic opportunities in 4 countries, Gabon, Egypt, Equatorial Guinea and Canada. Our 2P CPR reserves increased 292% to 76.4 million barrels of oil equivalent, and our proved reserves increased 149% to 27.9 million barrels of oil equivalent. The 2P CPR NPV10 value at year-end 2022 is $815 million, compared to our current market cap of around $500 million. We invested in drilling campaigns in Gabon, Egypt and Canada, and successfully completed one of the most comprehensive and complex operational projects in nearly 20 years at Etame, with the FSO conversion and full field reconfiguration. We developed and received approval for a POD from the Equatorial Guinea government for the Venus discovery at Block P and are negotiating final documents for the approval by the partners. We implemented the first ever dividend program for VAALCO that began in Q1 2022, and we nearly doubled the dividend in 2023, which paid out March 31st, while also implementing a $30 million share buyback program, and through the first 6 months of the program, we have returned $7.5 million to shareholders through buybacks. Our buybacks are governed by a 10(5)(b) plan that allows us to buy shares even during blackout windows, as it sets out our plan for the buybacks. We have been in a blackout period since December 2022. I would also like to point out that we have made the share buyback commitment in August of 2022 when oil prices were much higher, and we stress tested the buyback to $80 oil and communicated that commitment. We have continued to buy back stock below the $80 oil level, given that we believe the stock is undervalued and a good use of our cash flow. We are delivering on what we committed to the market and to our shareholders, and we are in an enviable position as we enter 2023. Our strategy is simple: operate efficiently, invest prudently, increase and return value to our shareholders, maximize our asset base, and look for accretive opportunities. In 2023, our guidance calls for a significantly lower capital spend profile, which should allow us to build meaningful cash throughout the year. In 2023, the forecasted CapEx range is $70 to $90 million, and we are forecasting about $45 million will be returned to shareholders through dividends and share buybacks. The plan for cash flow generated in 2023 over and above our existing obligations are to build up a reserve for future drilling campaigns and developments. In addition, we will look to enhance or accelerate the return to shareholders as well as evaluating potential accretive opportunities. However, our current projections show that the majority of the cash generation for 2023 above our obligations will be weighted in the back half of 2023 because our capital programs in Egypt and Canada are weighted towards the first half of the year. We are very excited for the future of VAALCO and remain confident that we will continue to deliver superior long-term value to our shareholders. Thank you, and with that, operator, we are ready to take questions.
We will now begin the question and answer session. To ask a question, you may press star and 1 on your telephone keypad. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star, then 2. We ask that you please limit yourself to 1 question and 1 follow-up for today's call. At this time, we will pause momentarily to assemble our roster. And our first question here will come from Stefan Foucault with Octus Advisors. Please go ahead.
Yes, hi, James. Thanks for taking my question, and thanks for the visibility on the moving part, working capital. I have some follow-up on that, and I'm trying to reconcile the balance sheet with some of the comments that you made, Ron. So, looking at that, the balance sheet has a big foreign income tax receivable of $68 million. Is that mostly Egypt, the $50 million you talked about? Ron, if you could confirm, that would be great. Then there is in the liabilities current $91 million, which I think is referred to accrued liabilities. I think it's mostly CapEx, but if you could confirm that, that would be great. And lastly, in the non-current liabilities, there are a big jump in the lease, whether it's finance or operating lease. And if you could confirm why it has jumped so much, that would be great. Thank you.
Hi, Stefan. Thank you for that. I'll take each one of those. The other net I think you're referring to, I think it's just the way the line is on the balance sheet. It's nothing to do with foreign income taxes. That's the line above. The other net of $68 million does include the backdated entitlement in the composition of that balance. As I stated on the call, that's roughly about $51 million that is within that particular balance. Looking through the accrued liabilities, there's a number of different things in there. You've got your accrued payables that is quite high at the end of the year. One, because we've taken in TransGlobe and you're virtually doubling the size of the company, so our accrued payables go up along with it. There's capital expenditure, which we've got accruals at the end of the year that has gone out in the beginning of 2023. I think that went up about $15 million from where we were the previous year. You've got always at the end of the year, you've got a higher accrued wages and compensation costs. That's basically a mechanical part in relation to the build-up of any bonuses or PTO during the year. And of course, within there, we've also got the current liability for the modernization payment for Egypt, which is approximately about $10 million. So as you take those things, those are the big increases that take you up to the $91 million that we have in there in the liability section. The leases, yes. I mean, we obviously had the Natipa in there as an operating lease before. It'd been there for 20 plus years. The telly was taken in. We went live with that in October. And at that point in time, it was a finance lease. That's taking into consideration that we've got a lease term of 8 years plus 2 one-year options. When you look at that from a US GAAP perspective and we work through, the standard, that becomes a right-of-use finance asset, and we have obviously both the asset and the liability to put onto the balance sheet. So that's really the main drivers and leases. You've got the operating lease for the Nautipa going off, and that was basically reducing over the last few years as it got through its contract life. And then you've got the new finance lease coming in the Tele, which will be there, for at least the 8-year period.
Thank you for that. So for my follow-up question, for the I'm coming back to in the current liability, the $91 million. How do you split between what's account payable, which is about 60, and what would be as part of this other accrued?
Yeah, I mean,
that goes into account payable, doesn't it? I'm trying to understand. Let me explain where I'm coming from. I'm trying to understand what's really, to avoid double counting when I look at the working capital, between what is part of the announced CapEx guidance and OpEx guidance and what is not. In other words, what might be carryover for last year or some payment that comes on top of the OpEx and CapEx guidance within this $91 million.
Yeah, okay, so obviously the accounts payable is in that separate section of 60 million, but to the extent that the invoices are in and we've got accruals, that's sitting with roughly between $25 and $30 million between all of the different areas. And then you've got capital expenditure, which is again about another $25 million that's accrued CapEx down in that particular line in the accrued liabilities and others. So you've got 50 million that I would say is a degree of timing. Traditionally for us that's been probably running about the 20 million mark in total, but again because we've doubled, virtually doubled in size with Transglobe coming in, you would think that 20 million should be somewhere between 30 and 40 million, Stefan. So I do think there's an increase overall at the end of the year that will unwind, but I don't think it's certainly nothing to the extent that that whole balance is going to reverse. I would traditionally see somewhere between 30 and 40 million staying in that account, period on period. The accrued wages, you're talking about $5 or $6 million of an increase there. There'll be an element of timing in Q1 as that unwinds. And then, of course, the modernisation payment, as we stated earlier, it was paid by offset in Q1 by EGPC. So basically, we've settled that 10 million liability that we had against receivables that we had with EGPC. So that will definitely move out in the period.
Thank you.
Does that help you?
Yes, thank you.
Thank you.
Our next question will come from Jeff Robertson with Water Tower Research. Please go ahead with your question.
Thank you. Good morning. George, you talked about incremental acquisitions, and with the Transglobe acquisition in 2022, which added 2 more countries to VAALCO's portfolio with a little bit different cycle times in terms of the project lives, can you talk maybe generally about what characteristics of an acquisition fit VAALCO in its current profile as opposed to what you might have been looking for a year ago?
Yeah, that's a good question, Jeff. I mean, first and foremost, the acquisition portfolio, for us to go and action anything, it has to be exceedingly compelling, particularly where our stock price is at the moment. And as I mentioned earlier, with a 2P reserve valuation, a PV10 of over $800 million, we've got a little bit to consider more investment in our stock buyback before we really go into a large acquisition. But part of the drive behind that and the drive behind the Transglobe acquisition was twofold. One was diversification and de-risking the revenue stream, and the second thing was the reserve base, so we have a longer life platform for the company. So when we look at the opportunities that are in the market at the moment, first and foremost, unless it's in our backyard and we are going into a new country, we're looking for producing assets. We're looking for assets that will immediately start to contribute to revenue and cash flow. And in addition to that, assets that fit our skill set. Now, our skill set has increased considerably since the acquisition of TransGlobe to include a lot of onshore expertise as well as shallow water offshore. And with that, similar to the driver for TransGlobe is to ensure we have a 10, 15-year lifespan around these reserves, so we have the longevity to report forward.
Thank you. And a question, and it sounds like the answer in terms of the free cash flow profile that you mentioned, Ron. With the capital program in 23 weighted to the first half of the year in Egypt, does that imply the production benefit from that capital starts to impact the second half of 23, and therefore you have growing production and less capex, therefore more free cash flow?
Yeah, I would say you're definitely going to have an impact on Q1 on free cash flow with the drilling underway, and we're already seeing some tangible production from that. So what I would say to that is you're very much correct, Jeff, in modelling it, that you've got a weighted part on your capex to the first half of the year, as we stated. So free cash flow will be impacted by that in the first half of the year, and generating a lot of free cash flow come the second half of the year.
Thank you very much.
And our next question will come from Charlie Sharp with Canaccord. Please go ahead with your question.
Yes, thank you, and good morning, gentlemen. I appreciate the presentation. Just a question, if I may, on the production expense. I guess two questions really on it. Firstly, I think you've assigned a range of 136 to 157 million. Can you give us an approximate breakdown geographically of that production expense? And then secondly on it, just looking at the production range that you've indicated, if I assume that the production expense range is related to the production range, that turns out a $18 a barrel production expense. And so I just wonder where that 16 to 20, which you highlight in the presentation, where that comes from. Is that related to production or partially related to production, or are there other factors? Thank you.
Okay, Charlie, I think I can take those. When we look at the overall guidance for the year, we assume production and sales are going to be the same for the whole year. And so most of the production expense per barrel of oil is actually done on a sales basis. So that's why those particular statistics look the way they are when you're calculating them. It will be based on effectively the sales barrels. When I look at the overall composition of that full year guidance on a per barrel basis, 21 to 27, I guess I would probably point you to a certain extent to the netback slide, just for confirmation of those costs. I know that they're blended in there, but when we look at the overall composition of the cost by area, the operating cost by area, by far the majority is obviously going to still be in Gabon. I would say that that's probably somewhere between 50 and 55%, Charlie. The remaining 45%, I would basically put that to Egypt and Canada. Obviously, I would weight that 40% in Egypt and the remaining part in Canada.
That's very helpful, thank you. And one small follow-up, if I may. You indicated that you've made some progress in terms of, I think you described them as documentation on Equatorial Guinea, and that there should be another update in Q2. Can you just say a little bit more about what that means, documentation? And in Q2, are you going to be able to give us some sort of flesh around the details of the plan as you see it at the moment to commercialize Venus, at least?
Okay. Well, I can say a few things, Charlie. One is that a few weeks ago we had some excellent meetings here in Houston with our partners and with the government, the MMH. In those meetings, what we've been working on for some time is, whilst we were looking at the plan of development and where we were in Q4 with that plan of development, and we got the plan of development approved, we still had a number of issues outstanding in relation to the amendments to the production sharing contract with regards to equity percentages that were historically not signed off properly, and one or two other issues. So we basically had two PSC amendments outstanding with the government. Both of these amendments were executed in March, and allow us to move forward to then finalise amendments within the joint operating agreement between the partners, which at the moment remain outstanding, so I can't go into the details of those, but we do expect those to be executed in the very near future. When we look at the development itself, we have in Q4 of 2022, we went through a peer review of that development, essentially looking at each of the gating criteria from the long lease drilling program through to the plans of doing an extended DST and the topside facilities. So we're currently optimizing that with the input of the peer review to improve both the efficiency of the development and reduce the complexity of the development. So when we look at where we are in 2023, the majority of the work that we'll do in relation to Block P for 23 will be finalising the studies work and coming up with the development plan as optimised. That may include looking at drilling all the wells at the same time, as opposed to drilling them staggered, just because the economics of moving the rig in there and leaving it there to drill the two producers and the water injector makes more sense. And then looking at the top side. So when we're looking at what real activity will happen in 2023, I expect we will complete our seabed survey to ensure that we can locate the MOPU and the rig in the location that we plan. We'll finalise the construction and engineering phase and be able to then put a more detailed timeline on the development towards the end of this year. It certainly is planned that when we can look at the drilling program for 2024, to utilise that same unit to drill the wells for us in 2025, early 25 for the Venus development.
That's terrific. Thank you very much.
We have time for one more guest with questions, and we will take questions from Bill Desolin with Titan Capital. Please go ahead.
Great. Thank you. I have two questions. First of all, would you please discuss further your comment in the press release that you are looking and expect to deliver more synergies with TransGlobe than originally anticipated? And I guess the spirit of the question is, I know you noted early in the call, $5 million of savings has been achieved, and you're looking for an additional $5 million with other administrative type expenses. Was that really the essence of the comment, or was there more beyond that we should be thinking about?
Well, I'll take the first part of the question, Bill, and I'll let Ron take the second part on the synergies. When we look at the expectation of further synergies, we're already when we look at the operating part of the business, both in Egypt and Canada, we're looking at how we improve the efficiencies of these operations. So when we look at what we've been doing at the moment through the latter part of Q4 and the majority of Q1, in the drilling campaign in Egypt, we've been reducing the time between drilling complete cycles. We in the last two wells, we've hit record reductions in that cycle time. So we're starting to see much more greater efficiencies when it comes to the drilling operations inside Egypt. we're applying that same methodology and with those same challenges to Canada to reduce the cycle time between drill and completion and hookup. That allows us to have these greater synergies, have the oil on production at a much earlier time, and obviously becomes much more efficient for our capital spend.
Yeah, just taking mainly the G&A component part of that synergies as well, Bill. I think we had put on our investment deck back at the time when we were looking for the shareholder vote that we were looking somewhere between 3 and 5 million on the short term. We've got more than 5 million on the G&A side right away. That's really achieved on a couple of fronts. First of all, we had the situation where TransGlobe was not only listed in Toronto but listed in London too. So we managed to combine, and with the VAALCO listing, we've managed to get out of those particular filings. So that saved a considerable cost. The UK office, effectively where the TransGlobe executives were based, all those TransGlobe executives they left the business on basically mid-January. So we got the savings that we were targeting very, very quickly. We've had a number of others in there that we've identified and worked through, including insurance costs, including the interest costs that they had on their ETB facility. There's a variety of different professional services that when we look at it, we're duplicative for both businesses, and we've managed to take those out. So more than 5 already achieved. I think where we're really focusing on from a G&A point of view now is we're looking at back office functions. We're looking at, I would think we will be looking at a ERP tool in the near future, so that we can get everyone on the same system rather than having 3 or 4 different systems, which we've got today. That in itself will bring efficiencies and I would say improvements in our control process too. So that's what we're targeting, Bill, for 2023.
That's helpful. Thank you both. And then relative to the Arta 77 HC well in Egypt that you said had encountered some good sands, what's the timeline to bring that on? And with the wells you are drilling in Egypt, what do you think about in terms of the what is a more normal production level?
Okay. The well's on cleanup right now, so can't really comment on the production rate until the completion of cleanup is done. But it is flowing. When we look at the changes we're making in both cycle time and production efficiencies inside Egypt, I think we had Egypt going down around 10,000 barrels a day working interest towards the turn of the year. We're already seeing at least a 10% improvement in that as we come into the end of Q1 on a working interest, on a gross basis. So we do start to see improvement. We're looking at how much more we can get efficiency out into the production system in Egypt. We've looked at some of the activities that they perform annually in tank emptying to the storage facility, and we're looking at moving these quarterly to start to reduce these cycles that we see traditionally in Q3. So and I think we're starting to see benefits from that. When we look at the relationship between the company and its joint venture partner in EGPC, we're seeing considerable improvements there in cooperation and again in how we execute the program. So I think we're still very hopeful that we can continue to improve the efficiencies in Egypt. It is one of our key focuses. You heard Ron talk earlier about the cash situation and how we've been managing that in Egypt. We've seen other operators make statements around Egypt and the cash position as regard to the difficulties and liquidity that country is going through. We keep a very close focus on that and a very close dialogue. we will, as long as the operation and the interaction with our partners remains as it is at the moment, we'll continue to make the improvements and make the investments.
That's helpful. Thank you. And then my final question is that you spent, a fair amount of time in multiple components of your opening remarks or your prepared remarks referencing VAALCO being undervalued. With that being said, what do you think investors are missing, whether it be relative to the TransGlobe acquisition or in total today, that's leading to that lack of favorable valuation?
That's a good question. I mean, as you know, we've discussed in the past. You know, traditionally, in either the London market or the New York market, an African-focused producer always trades at a discount. The level of discount is what we need to discuss. What's the market missing? Well, I think we've made a big step towards giving the market the confidence with the valuations today, because what the market may have been missing, and it's a number of questions have come from the analysts both in London and here in the United States, is the longevity. You know, where are the reserves? Where's the position that goes 2, 3, 4 years out that we can invest in that gives you surety around the cash flow? The TransGlobe acquisition, in addition to the position we have in Gabon, provides that surety. The development that we've went forward with in Equatorial Guinea, gives us that forward-looking position. It puts a lot more value into our balance sheet in 2022 through Equatorial Guinea, through the acquisition, than has ever been there before. And I think the market's missing that at the moment. We continually, from the numbers we've guided to for 2023, we're guiding to a significant number in revenue and production, which will lead itself to a significant number in EBITDAX that we don't guide to, but people can work that out. So I think once the analysts sit down and run that equation, and you say that you're basically running at sometimes less than 2 times EBITDAX, then we're looking for that step change in value as we continue to emphasize these values that are in our balance sheet.
Great. Thank you both, and have a good weekend.
Thank you, Bill.
Thank you, Bill. And this concludes our question and answer session. I'd like to turn the conference back over to George Maxwell for any closing remarks.
Thank you. I'd like to thank everyone for listening into our delayed 2022 earnings call. It's hopefully from the listeners that we've managed to put a lot more color around our Q4 and 2022 activities, and also put some color around where we see 2023. And some of the questions we've been asked have assisted in us given the ability to emphasize that point. I think the company has clearly transformed. I think when you look at the numbers that we talked about today, particularly with regard to our ability for cash flow generation, our ability for the reserve base in the company for future value, our ability in utilizing that cash and delivering significant value back to shareholders, not just in the potential for capital appreciation for the stock, but also in dividends and buybacks. You heard me state in the closing remarks that we will also look at the opportunity to continue and perhaps accelerate that buyback position as soon as the company comes out of its blackout period, which will be sometime in May, with regard to our Q1 results. Again, the commitment is there to continue to do that while the stock price clearly is in a depressed state versus the value that we've been talking about that contained in our balance sheets. So I thank everyone for listening today. As I say at the end of every call, for every shareholder, if they want to get in touch with Al or Chris and want to have a follow-up conversation with management, we're always willing and able to do that. Thank you very much.
The conference has now concluded. Thank you very much for attending today's presentation. You may now disconnect your lines.